Evening and welcome to the Money Show. I'm Kavita Thapliyal. Union budget this year sends out a clear message. India is entering a phase where simplicity, stability and long-term thinking are being prioritized across the financial system. Beyond the headline, numbers and announcements, what stands out in the intent? An intent to clean up old frameworks, reduce friction, encourage transparency and align rules with how people actually earn, save, invest and spend their money today. From household savings and retirement planning to global mobility and capital markets, the direction is unmistakable. Fewer legacy distortions, clearer rules and a stronger emphasis on formal long-term participation in the economy. For investors, this matters deeply because policy doesn't just shape government revenues, it shapes risk appetite, capital allocation and investor behavior. It influences whether households prefer gold or financial assets, whether investors chase short-term trades or stay invested for the long haul, and whether India continues to attract patient, long-term capital. This budget also acknowledges a reality that can no longer be ignored. India's investor base has matured. Millions of first-time investors are now participating in mutual funds, equities, retirement products, and global assets. With that maturity comes in the need for clarity over complexity, predictability over patchwork rules, and confidence over ambiguity. At the same time, the government is signaling that the era of loosely enforced rules is giving way to one of structured compliance, but with smoother processes, fewer touch points and greater use of technology. So today on the Money Show, we are not just decoding policy announcements, we are asking bigger questions. What does this changing policy environment mean for investors and savers? Are markets being nudged towards long-term discipline? And how should individuals rethink their financial strategies as India's regulatory and investment landscape evolves? To help us unpack all of this, I'm joined by three voices who see this ecosystem from very different but equally important vantage points. Dhirendra Kumar, founder of Value Research, who brings the long-term investors' perspective. Tarun Garg, partner at Deloitte, who help us understand how policy intent translates into the real-world impact. Vishal Kapoor from Bandhan AMC to assess what this means for markets, mutual funds and investor behavior. This conversation sits at the intersection of policy, markets and personal finance. And that's exactly where long-term wealth is shaped. So let's begin. Hi, good evening, all three of you. Welcome to the show. And Dhirendra, I'll come to you first because, stepping back from the technical details, I just want to understand from you, does this budget mark a genuine shift towards taxpayer-friendly simplicity, or is this more of a compliance cleanup packaged as reform?
No, this is none of it. It is a boring budget, and it only points to looking at the budget number. We are a stable economy, we are a growing economy, and we are a disciplined economy. The deficits are in control, and there were tweaking here and there, and we have some growth-oriented things about the biopharma and the AI was talked 10 times, was referred 10 times in the budget speech and all that. But continuity, predictability, nothing surprising. And yes, one thing interesting from an investor's perspective is that speculators are being penalized. Hopefully, some of them become long-term investors.
All right. Hopefully, we will become long-term investors. Tarun, the headline announcement is the new direct tax code effective April 1st, 2026. From a practitioner's point of view, let's just understand how different will compliance actually look for an average taxpayer once simplified forms and returns come in?
No, so Kavita, actually, the fraternity was expecting that this new tax, direct tax bill, or rather the new Income Tax Act 2025, may get pushed to one more year because, of course, the rules, we were thinking that these are in the process and all. So, but against our expectation, this budget has said no. The Income Tax Act 2025 is effective from 1st of April 2026 onwards. again, it's a welcome step in a way, because the government is already doing so much in terms of rationalization of tax return forms, simplifying the returns, pre-filled return forms that already released in past few years. So yes, we are thinking that from a practitioner point, again, you have to learn all these new section references, because we were very used to kind of quoting the earlier sections for Income Tax Act 1961, and so were the taxpayers very used to kind of remembering those. So that will go a change. Then also so many rationalizations that they've done in terms of compliance, say increasing the time limit for people who are like non-audit cases earning professional income. That deadline has been increased to 31st of August. Then towards decriminalization of certain aspects, say in terms of the fact that if you've missed reporting your foreign assets, so the prosecution aspect has been kind of removed. So all these things are coming, and when we are going deep into the finer prints, again, some changes in the provident fund things are also kind of emerging. So Kavita, all in all, a good kind of a budget, but yes, because lot many highlights were already given in the previous budget of 2025, so not much was there in terms of rate tinkering. But yes, middle class and all were still expecting some sort of a hike in the standard deduction in the new tax regime, which like of course didn't happen. Yeah.
Absolutely. So more or less on the expected lines. Vishal, I'll come to you. You know, Vishal, markets reacts not just to rates, but to certainty. Now, I just want to understand your take on this as far as the budget concern goes, and also around capital markets and, you know, investors' disclosure, reduce uncertainty for long-term investors. How are you looking at it?
Certainly, Kavita, I think the points made about the need for stability, especially when we look at it in a global macro perspective, with a fair amount of heightened volatility all around. I think it's almost welcome to see a budget, as Dhirendra put it, a boring budget. It's a good budget from that standpoint that it's not trying to do too much. I think fiscal consolidation is along the path that was expected, and it's good to see that it has realistic expectations from both revenue, and it's great to see the thrust on capex. Capex growth seen higher than nominal GDP growth. That's very welcome. So, in a sense, the continuity is what is very welcome. And along with that, some of the themes around, like you mentioned, simplicity. Helping the taxpayer actually move to a much more enabled compliance environment. Reducing the amount of sort of speculation that was going on, and promoting long-term investing, hopefully through mutual funds. Those are things that we are very hopeful and thankful for, because I think in the macro environment globally, this is probably the best balance that we could try and find.
Dhirendra, let's talk about the STT on futures. Impactful move, or a lot more could have been done? And is it really going to see some kind of a effect coming in?
No, it's quite impactful. In fact, if you look at what SEBI has been coming out for the last 2-3 years, that what percentage of participants in this segment of the market lose money. It has been upward. It started from 92%, went up to 94%. And going by what has happened, and it's you go by this cost framework, the way it will radically alter. This is not a small change. This is 150% increase in futures, the STT increase. Likewise, on the option premium going up from raised to 0.15 from 0.1, it's a 50% increase. Likewise, for option exercising it, STT raised from to 0.15 from 0.125. These are big jumps, and this will completely or substantially alter the economics of the trader. And trader will have to take out their calculators and figure out that if this rates applied on their last year transaction, they lost money, how much more they would have lost. And this might be not a nudge. It is a wake-up call. But I really wonder that, investors, these speculators actually look at things that objectively. a good number of them, a large majority of them will be doing it for fun. Maybe the reality drives, they get a blow to really understand and decode this objectively.
Vishal, do you second this now?
Yeah, I think clearly the thrust between both STT going up as well as I think there was a provision we heard about where interest cost offset, which was earlier available, is not going to be available. I think both of these actually almost penalize high frequency traders, and therefore the nudge towards longer term investing. I think that seems to be the theme. So yes, to that extent, I think the market or the speculator may not be as happy in a sense from this budget. But like we mentioned earlier, I think this probably almost refocuses the investors, gauge onto longer term investing, to sticking to what makes sense rather than getting carried away with things that were looking a bit more, I think, overheated almost, if I can call it that, as part of the market.
Tarun, there's been significant movement on overseas assets, reduced TCS under LRS, immunity for small foreign assets under 20 lakh, and a one-time 6-month overseas asset disclosure scheme also. How strong a signal is this for voluntary compliance, and who should seriously consider coming clean now?
Now, so Kavita, very important question. See, what we have been also seeing in the last 1 year or so, the government has been running so many campaigns, and one such recent campaign was a nudge campaign where they were getting so much of an information under the information exchange agreement or double taxation treaties that they've entered into with various countries, and they were kind of asking the individuals to come out clean or just file their revised returns or updated returns if that be so, and then pay the penalties and then come out clean. But then one important aspect under the Black Money Act was that the prosecution risk was still there, even though they had increased the limit from 10 lakh to 20 lakh worth of those assets, but still there was what you can say was ambiguity in terms of prosecution. So now that has been clarified that with retrospective effect, such prosecution will not be applicable from 1/10/2024. Another aspect that you called out, that there are so many individuals, like even students visit, a lot of techies go out and to gain experiences, say for 3-4 years project overseas, and typically they do acquire some bank accounts, some small sort of investments or assets, and then they tend to forget once they are back in India. So in such circumstances, there were a lot of such cases that was coming to the government, and in fact, there was a representation that was made that you should not be penalizing such, and in the wake of ease of doing business, the prosecution or penalties should be kind of rationalized, and that's what the government has done. So prosecution has been done away with, and even in terms of penalties, that has been reduced substantially. So the government is saying either you pay 30% of the market value of those assets, or you can pay whatever is the taxes due plus 30% as a penalty. So again, yes, a very welcome move, and people who want to come out clean and think that they are being deterred because of huge risk of prosecution, they should avail this new kind of scheme that the government has proposed.
Absolutely. Dhirendra, just to understand, what could be the reason that the government did not announce a complete phase out of the old tax regime? And also, there were rounds of talks going on making the new tax regime more attractive, by having the home interest tax cut over there. But then all of this was not the focus in the budget at all this time. What, according to you, could be the reason?
Very straightforward. A lot of investors over the last 5-10 years would have bought their house based on a certain premise. They may not, and for them, the old tax regime will still be relevant. They will be taking all the tax breaks in the old regime, which they are entitled to and eligible for. And new tax regime is relatively new. It will take some years for them to phase it out, and it will not be relevant for many of those people. So if somebody bought a house based on all the concessions that he will get, he'd made all his investments accordingly, So just to maintain a status quo for the old, old taxpayers who are which they were used to. So not disrupting their plan, their financial plan. That I think would have been the case. One thing which was crossing my mind while I was talking about this, the increase in STT, and this question is primarily for Vishal, that is the unintended consequence of this increase in STT will actually impact the arbitrage funds, arbitrage mutual funds? Will it dent it very severely?
Yeah, I think, yeah, at least back of the envelope calculation, Dhiren would suggest that some amount of, I think, the current yields may be dampened a bit because arbitrage funds do have a higher STT outlay after this change comes into effect. But as you know, from a net tax, post-tax yield standpoint, I think we just have to see how it plays out. And on a relative basis, therefore, some bit of the fixed income market maybe less disadvantage, if I can call it that. Therefore, I would watch out post April for maybe a higher allocation towards fixed income or some of the hybrid products which are able to combine fixed income with arbitrage. Because certainly the reliance on arbitrage that we've seen from high net worth investors to avail of steady returns on a post-tax basis may get dampened a bit because of this STT.
One question for Tarun over here. Tarun, the PF changes are being described as a technical cleanup, removing outdated percentage rules and aligning everything with EPF monetary caps. Now, in plain English, does this simplify life for employers and employee, or are there transition risks people should watch out for?
So see, it is a kind of a cleanup, Kavita, because see, under the new Income Tax Act 2025, they've just copy pasted, and of course the language they made it much simpler, and as was kind of called out in September or when this new Income Tax Act got kind of finalized, there also they had said like it is not kind of a taking away of what has been there in the previous legislation, but it is more of a cleanup exercise because lot many provisions were outdated, and it was leading to some sort of a confusion that, look, say if the employer is contributing 12%, then if it is up to like 7.5 lakh, that was not taxable. But if employer contribution was in excess of 7.5 lakh, that is any which ways it is taxable. But somehow if the employer contribution is in excess of 12%, that was getting taxed twice. So those provisions this budget has tried to clean up, plus the fact that they are giving more sort of a flexibility in the employer's hand if they want to have like make some flexible contribution towards provident fund. So that ways it is kind of welcome step, but again one has to go through the finer prints more carefully to be just able to decode this. But again, my first sense is that it's more of a cleanup exercise that they have done.
Dhirendra, on the interest on, motor accident claims tribunal award is now fully tax exempt. Now, will this, while this is a relief measure on the face of it, but does it also reflects a broader shift towards protecting vulnerable taxpayers? How do you read into it?
Oh, not only this, if you look at all the kind of concessions made, that the last date of revising your tax return has been extended, the whole language and the expression in all such changes was quite compassionate. It was sympathizing with the taxpayer. Earlier, it used to be that somebody has violated, whether it be technical or deliberate or any scale, the decriminalization of many of the things which would have been inadvertent, which would be unintentional, or sometimes it could be an omission, sometimes it could be forgetfulness. So I think, and this looks like, howsoever late, well done.
Vishal, one thing, tax-free maturity for sovereign gold bonds now applies only if held till maturity, while buybacks will be taxed as capital gains in investors' hands. How should investors rethink gold and equity strategies in the light of these rules?
So I think on the buyback, that is certainly a very large positive because earlier, if as an investor I wanted to offer my shares back as a buyback form, I would have to pay marginal tax rate as against long-term capital gains, which would otherwise apply. And therefore, the reduction in capital, which may be the sensible thing to do for an organization, was not really as friendly or as neutral. So this certainly gives the investors a better way to have the right capital structure for the company. So that will be seen as a very large positive, I would say. On sovereign gold bonds, again, I think if you're an existing holder of the gold bond, we'll have to see how this applies, which is, does the tax rule apply only for fresh SGBs bought in the future, or does this also apply for, bonds that you already hold? I think we'll need some more clarity on that because certainly if this applies next year for existing bonds held, then you would be at a disadvantage relative to what your position was when you bought into the bond. If you look at bonds that are going to be, and there are no issuance happening right now, so the fundamental attractiveness of the SGP does go down. And now that with ETFs and fund of fund ETFs, etc., many other ways to hold precious metals being available, I would say a lot of the market may actually move to that part of the financials market rather than SGPs because of this move.
Tarun, one explanation needed. Now, we are seeing PAN-based filing replacing TAN and NRI property sales, automated lower TDS certificates, Form 15G, 15H filing through depositories and, extended due dates. Now, is this the most serious push yet towards faceless, frictionless administration?
As Kavita, you rightly called out in your question itself, it is a faceless administration that the government is wanting. See, I'll come to the first part of your question where, see, a lot of NRI sellers who were holding properties in India and wanting to sell their assets, they were facing a constant challenge. In fact, lot many buyers were used to kind of shun away from even buying the property. The reason was like simple that there was lot many additional compliance that they were required to do. They had to obtain a TAN number, TAN number, and then instead of just simply filing 26QB, they were forced to go through such a tedious exercise, obtain TAN, and then do those compliances, which was leading to a lot of sort of challenges. So that was a much sort of a demand given by the industry, and which government has sort of complied with. Again, a very step in the positive direction. Now coming to the second aspect for these form 15 GNH filings, it is basically form 15 GNH, as we kind of know, it's a lower kind of a deduction certificate where the individual declares that his income is lesser than the threshold, and so there should not be any tax deduction. Now imagine if an individual is holding so many bank accounts, then he used to file form 15 GNH with all those banks, so as to ensure that no TDS gets deducted by that payer. Now he just needs to comply and file it with the depository participant, and then they will in turn give that to the respective banks or the security provider, and then hence there will be no kind of TDS applicable. So again, a very positive step, and it saves a lot of paperwork, Kavita. Imagine submitting multiple forms versus just one filing, and then your job is done. So a very welcome move.
More points to discuss with all three of you, but then it's time up on the show also. But then one question, and I want all three of you to answer. Dhirendra, I'll start with you. If you had to give one piece of advice to taxpayers or investors preparing for April 2026, what should they start doing right now?
They should. It's not about start doing something. It is stop doing something, which is stop speculating, start investing, and don't expect bonanza, and expect growth, and you'll be a beneficiary of that. Stick to your plan and do as little as possible.
All right, Vishal.
I think I'll add to that, certainly very wise piece of advice from Dhirendra, which is, stop speculating, start investing. There are, I think, through the budget, there are many additional opportunities that have been unleashed. So we should keep an eye out for that. Also, it's a good time to review your allocation once again. It's always a good time, but this is a great time to do that. So look at fixed income once again in the light of how, with STT, how the arbitrage market may move. And there may be some other products which will offer potentially very attractive opportunities going forward relative to what your choice may have been in the past. And certainly within the equity markets, there are lots of opportunities. And therefore, I'm sure the fund managers will be doing a lot of the hard work in terms of reallocating or looking at new opportunities. So you don't necessarily have to do a lot, but it's a good time to just do a fresh review of your allocation.
With a like lot many has been covered, but being a tax professional, I would say from an investor's point of view or individual salaried class point of view, one needs to kind of see where their allocations have been, and if somewhere non-compliance has happened, it's a great step and come out clean. If an individual is not disclosed foreign income, declare it now, and then you are getting your sleepless nights over. And then again, like in even in terms of say revised returns filings, all those things have been kind of taken care of by this budget. So just have a look at where your incomes are, assets are, and then make those checklist and then start filing, because again this year forms will also undergo a change. So yes, just do kind of that exercise.
All right, so quickly to close the show, as we end today's discussion, one theme cuts across everything we've heard. India's financial ecosystem is becoming more structured, more transparent, and more aligned with long-term outcomes. Whether you look at policy direction, market signals, or investor participation, the push is clear towards discipline over speculation, clarity over confusion, and consistency over frequent rule changes. For investors, this is both a responsibility and an opportunity. Thank you so much, all three of you, for being a part of this discussion today. Thank you so much.
Thank you.
Thank you.
And with that, it's a wrap on this edition of Money Show as well. Thank you so much for watching. Goodbye.